In 2025, commercial real estate is being rewired by AI underwriting, blockchain tokenization, and emerging U.S. digital asset laws like the Genius and CREquity Acts. Together, they're changing how a $38+ trillion market is financed, traded, and owned. In 2025, real estate remains one of the world's largest asset classes, with a vast global commercial market and a multi-trillion-dollar investable CRE universe. After the 2022 to 2024 correction, U.S. commercial property investment volumes are recovering, but unevenly. Office continues to see steep value declines and refinancing stress, while industrial is absorbing new supply and facing higher vacancies. Retail, by contrast, is showing surprisingly strong occupancy and cash flow resilience. These splits are reshaping capital flows, creating distressed deals and attractive risk-adjusted yields for private credit and AI-driven CRE financing platforms. U.S. commercial real estate hit a transaction peak in 2022, then volumes fell sharply as rates surged, credit tightened, and buyers demanded discounts. The market bottomed in 2024, when repricing and refinancing risk made price discovery difficult. Into 2025, activity can recover as bid-ask spreads narrow and financing terms stabilize, with more deals shifting toward private investors later in the year. Tokenization adds a second growth lever. It can lower minimums, improve access to illiquid assets, and expand the traditional CRE total addressable market. Tokenizing commercial real estate can expand what's investable by breaking buildings into fractional, digitally transferable interests. That lowers minimum check sizes, widens participation beyond local buyers, and makes cross-border allocation simpler. Token rails can also shorten settlement and improve secondary trading, reducing the frictions that keep CRE illiquid. Market forecasts reflect this shift. Traditional CRE is expected to grow steadily, while tokenized CRE and the broader real-world asset tokenization market could expand much faster as regulations clarify and institutions adopt. Institutional real-world asset tokenization is no longer theoretical. It's scaling. By early 2026, tokenized RWAs are projected to exceed $24 billion, with most value concentrated in yield-generating products, especially tokenized U.S. Treasuries. That mix matters. Institutions are starting where cash management and transparency benefits are clearest, not with the hardest to standardize assets first. Meanwhile, tokenized real estate and private credit remain smaller relative to massive underlying markets like U.S. CRE debt outstanding, creating a large runway if adoption and regulation keep maturing. In 2025, commercial real estate is emerging as the next major tokenized asset category as institutions grow comfortable with on-chain instruments. Tokenization turns a single building into fractional shares, widening the investor base and improving liquidity. Stablecoin settlement can replace slow escrow cycles, moving capital in minutes instead of weeks. Smart contracts add programmable compliance, KYC, transfer restrictions, and reporting, so deals can scale without manual back-office friction. Yet most real estate firms still aren't tokenizing, creating an opening for early platforms pairing AI underwriting with blockchain rails. Two 2025 bills reshape how tokenized commercial real estate can actually settle. The Genius Act creates a federal framework for payment stablecoins. Only regulated issuers, full reserve backing, required AML/KYC, and compliant payment stablecoins treated as non-securities. That clarity can compress escrow cycles from days to minutes, cut cross-border fees, and enable smart contract escrow, rent flows, and stablecoin-denominated private credit tied to CRE deals. The CREquity Act complements this by defining broader digital asset categories and agency jurisdiction, reducing uncertainty for tokenized real estate offerings. For tokenized commercial real estate, liquidity depends on clear rails and clear labels. The Genius Act can legitimize stablecoins as regulated settlement instruments, helping secondary trades clear faster with auditable reserves, AML/KYC, and compliant custody flows. The CREquity Act can reduce "is it a security?" ambiguity by classifying digital assets and creating a certification pathway, enabling regulated venues to list, broker, and custody tokenized CRE more confidently. Combined, these frameworks could expand crypto-backed CRE lending, improve mortgage and private credit underwriting, and lower friction across the secondary market. In commercial real estate lending, time to close is often the hidden cost. Under the Genius Act, regulated stablecoins can act as always-on settlement rails, enabling 24/7 deposits, payoff funds, and lender disbursements, so closings don't wait on banking cutoffs. That compresses origination and settlement timelines and increases transaction velocity across brokers, escrow, and servicers. In parallel, the CREquity Act's digital asset classification strengthens the legal footing for tokenized real estate to be pledged as collateral, supporting crypto-backed CRE loans and inviting more institutions through clearer compliance. From 2025 to 2029, commercial real estate hits a refinancing wall. Over $4 trillion of loans mature, with annual maturities peaking around 2026. Many of these loans were written in a low-rate era, so refinancing at today's rates can break debt service coverage unless sponsors add equity, extend timelines, or accept revised terms. That creates a large, time-sensitive need for transitional capital, bridge loans, value-add financing, and flexible structures. As banks pull back, private credit is positioned to price risk and provide liquidity. In Q2 2025, the CRE maturity wall is most acute where loans sit today, bank portfolios and CMBS shelves with heavy near-term maturities. After the price correction, many assets refinance at higher loan-to-values and weaker DSCR, creating an equity check sponsors can't always write, so a refinancing gap opens. Regulators are also pressuring banks to trim CRE concentrations, shrinking lending supply even further. That vacuum is increasingly filled by private and alternative lenders offering bridge capital, often $10 to $100 million deals, priced around the low to mid-teens with fees. Since 2022, banks' share of commercial real estate originations has dropped as higher capital costs, tighter supervision, and balance sheet pressure make them less competitive, especially on transitional and value-add loans. In that gap, private capital has scaled fast. Alternative lenders and private credit providers are taking more non-agency closings, raising larger pools of capital, and growing real estate debt fund AUM. With banks still managing CRE concentration limits, market forecasts point to continued expansion in private credit volumes and CRE-focused debt strategies through the decade. In 2025, commercial and multifamily mortgage markets show improving momentum as origination volumes rebound and private lenders continue to capture share. Bridge and DSCR programs are shifting. Average loan sizes are normalizing, volume is concentrating in higher quality sponsorship, and spreads are tightening versus 2023 to 2024, even as prevailing bridge rates stay relatively high. Fundraising also reaccelerates with more capital being deployed into senior bridge, preferred equity-like structures, and CRE credit sleeves. Zooming out, global private debt AUM keeps expanding, enlarging the addressable market for CRE-focused loan programs. CREquity.ai's addressable market spans 6 loan programs: business capital, bridge loans, value-add financing, non-QM investor loans, crypto-backed CRE loans, and in-ground asset finance. Together, they widen the funnel across sponsor types, collateral profiles, and speed-to-close needs. The macro tailwind is private credit growth from 2023 through 2026, rising U.S. private credit volume, a growing CRE slice, rebounding CRE originations, and increasing alternative lender share of closings. CREquity.ai's target capture translates these trends into measurable platform scale. CREquity.ai is built for a CRE finance market where speed and certainty win. The platform uses AI-powered underwriting to triage deals, price risk, and move to funding faster than traditional lenders, often in days instead of weeks. Its core products target today's liquidity gaps: Flex 50 bridge loans for time-sensitive transactions, BTFU bridge to stabilization for value-add execution, and non-QM asset-based solutions for investors who don't fit bank boxes. A crypto-backed lending program extends this edge as Genius and CREquity shape compliant stablecoin settlement and tokenized collateral. CREquity.ai modernizes commercial real estate lending by combining AI underwriting with a blockchain-based tokenized settlement layer. AI-driven valuation and credit models standardize pricing, accelerate approvals, and surface key risks early. Digital workflows automate document collection, audit trails, and compliance checks to reduce errors and delays. On-chain settlement can enable faster funding, clearer ownership records, and the potential for fractional participation in CRE debt. The result is direct lending 2.0, broader access for borrowers and investors, including crypto-backed CRE financing without sacrificing controls or transparency. 2025 is shaping up as the convergence year for commercial real estate debt and tokenization. Global CRE sits at massive scale, while a large maturity cycle forces refinancing decisions under tighter bank balance sheets. As banks retrench, private credit and alternative lenders are capturing share with faster, more flexible capital. In parallel, real-world asset tokenization is scaling rapidly, led by tokenized treasuries, showing that on-chain issuance, transfer, and settlement can work for institutions. With clearer regulatory milestones emerging, tokenized CRE debt moves from experiment to practical tool. Genius and Clarity move tokenized CRE from promising to financeable by clarifying how stablecoins and tokenized assets can be issued, held, and settled in regulated markets. That matters as a large CRE maturity wall collides with slower bank lending, pushing borrowers toward private credit for speed. Senior secured real estate debt funds look attractive when yields are compelling and closings are predictable. Next, regulated crypto-backed CRE lending can expand demand by bringing digital asset holders into the capital stack. CREquity.ai targets this shift with AI underwriting and blockchain-settled funding programs. As the 2025 to 2026 refinancing wave hits, a new borrower segment can help fill the capital gap. Digital asset holders who want liquidity without selling. Crypto-backed CRE lending uses pledged crypto as additional collateral alongside the property, potentially improving credit support and enabling faster execution. With Genius and Clarity pushing clearer rails for stablecoin settlement and market structure, platforms can design more regulated custody, margining, and liquidation triggers. Pair that with AI underwriting and you get private credit speed when banks stay cautious. 2025 reports highlight rapid global growth in private debt and the private credit market. Estimates put private credit at around $3.5 trillion, signaling expanding non-bank capital pools.